by the age of 32, I've been able to become financially independent. Okay, that means the passive income from my business, from my investments, it exceeds my generosity, my expenses, my taxes and savings, and I don't have to trade time for money anymore. And I want to teach you how I got there, because a 32-year-old kid from Anchorage, Alaska with 60 kids in his graduating class, a C average student, there's no reason why that should happen unless I figured something out. Hey, what is going on? This is Jerry Fetta, CEO and founder of Wealth Dynamics. Hope you're having a good evening here. Welcome once again to Finance Friday. So, if you've not tuned in before, right, I want to give you an introduction to who I am. As I mentioned, I'm the CEO and founder of a company called Wealth Dynamics. But the focus of this course, it's something I've been doing for about 5 years now, right? 5 years in a row, doing Fridays. We switched to Saturday for a little while. We do Fridays again now, right? But I want to thank you for tuning in. If you're watching here live on a Friday night, if you're watching the replay over the weekend, if you're during the week watching this or listening to it on the podcast in your car, I want to give you an attaboy or an attagirl, right? And the reason why is that tells me that you care about your finances, right? 8 out of 10 Americans live paycheck to paycheck, and the majority of them are doing nothing about it. Right? You may not be paycheck to paycheck, maybe you are, but the key is you're doing something about it. You are learning, you're getting educated, and I have to commend you for that, because it's more than I can say about a lot of people out there that are struggling and they're just not gonna get up and do something, right? Now, who am I to teach this course? I wanna share who I am and some of my background. I've been in financial services since the age of 18. I'm 32 years old now. I've worked with Grant Cardone, Dave Ramsey. I've worked with Forbes. Inc. 5000 listed me as the top 100 fastest growing financial firm in the United States in 2023. I'm a published author of 5 or 6 books, one of them being The Blueprint to Financial Freedom, which is what we're covering tonight, right? But all in all, the reason I'm sharing this course is not because I'm some financial genius, okay? I studied the top 1% of wealth for over a decade, and I started to look at what is it that they're doing, right? What is it that they're doing with their wealth? How are they building wealth? Why is it that from generation to generation, their money stays? And we hear phrases like, why do the wealthy get wealthier? How do the rich get richer? Right? And I started to study that because I was a financial advisor first, right? I started to study it because I was like, I need to understand what's going on here. How are these wealthy individuals investing? And I started to learn it's very different than what we're being taught. Right? It's not the same thing that we're being taught by banks and by Wall Street and by financial institutions. Okay, and so what I started to realize was that there was a pattern there. Right? There was a pattern there, and the wealthy are all investing in these things because that's what they're taught. That's their education. Right? So I'm going to share with you tonight some information on this topic because most of us aren't building wealth the traditional route. Okay, I'm sure we can all agree Wall Street's not out to help us. They're out to make a buck, right? We can probably all agree that the banks, they're not our friends either, right? They're responsible for things like 2008. Okay, so when we look at all of this, it's like, okay, we've got to figure out how to build wealth, and we're not getting a lot of help from the government. We're not getting a lot of help from schools, right? And so this is something we've really got to take in our own hands and focus on our own. So I'm going to share something here on my screen that I want to cover with you guys tonight. This is some information from my book, The Blueprint to Financial Freedom. And this really is something that if you pay attention tonight and you watch this or you listen to this with the standpoint of improving your finances, right? How do I improve my finances? How do I get better at this? You know, how do I learn the same stuff the wealthy are learning? Because that's what I was able to do. And the result was by the age of 32, I've been able to become financially independent. Okay, that means the passive income from my business, from my investments, it exceeds my generosity, my expenses, my taxes and savings, and I don't have to trade time for money anymore. Hey, what's up? Jerry here. I just wanted to give you another reminder. Grab my book, Blueprint to Financial Freedom. It's going to be one of the best books you have ever read on finance. I can promise you that. You're going to love it. It's also a free offer. So if you go to jerryfetta.com/B2F promo, you can get that now. And I want to teach you how I got there because a 32-year-old kid from Anchorage, Alaska with 60 kids in his graduating class, a C average student, there's no reason why that should happen unless I figured something out. right? And I'm telling you, it wasn't mine, it's the wealthy that I studied, right? So tonight, Finance Friday, this is about simple, true, and applicable financial training so that you can improve quality of life for yourself, your loved ones, and the world around you, right? It's about gaining financial understanding so you can have a better quality of life. That's what this boils down to, right? Now, here's the thing. Here's the problem. Right? You either have time or you have money, you don't have both. Number one issue in life is people aren't in a position where they have this ability to have time and spend the time the way they want to because they don't have the money. Right? They don't have the money. And why don't they have the money? Well, because they don't know the things I just talked about. Right? Or they have the money, but they're so busy that they don't have time to actually do the things they want to do with the money. Right? So what ends up happening? We end up in this, okay, good, I'm either so busy that I can't enjoy the money I have, or I've got time on my hands, but I'm so broke that I can't use it the way that I want to. Right? And that is what's really kind of holding most of us back in life from doing the things we want. So the way that we've been taught is we've been taught that it's an optional system. You only can have one. Right? You have the money first, and you work and you do the 40-year career thing, and you save up in a retirement account and all this stuff, and you don't have the time. And then when you finally retire, you can then have the time, but you're never really going to have them together, right? The number one fear of a retiree is running out of money. The number one fear of someone that's working is not spending time with the family that they love and doing the things that they love, and then dying and never having the time to enjoy those things. Putting life off till later, and then later never actually shows up, right? So the solution here is financial independence. The thing that I mentioned, passive income that exceeds your generosity, expenses, your taxes, and your savings, right? And so if you've got financial independence, you have the ability to have both of them, right? It's something you actually can do, and that's something that the wealthy have done. Now, here's the problem. Only 5% of people actually become financially secure, even at retirement age. That's not even financial independence, right? We're talking about the retirement system. The very thing we just said is not a very workable system. It's not the best setup, and only 5% of people are achieving that. Even less are achieving financial independence, right? So I'm going to share with you tonight something from my book, The Blueprint to Financial Freedom, that's going to help you out quite a bit on this, right? So this is my book. It's, again, Blueprint to Financial Freedom. You can grab a copy of this if you'd like to. It's jerryfetta.com/B2F promo. If you get the ebook, you'll actually have that in your email. You can follow along here in the book as well, right? But I'm going to read you guys something from this book. This is from page 18, okay? So this is something called an accredited investor, right? And it goes like this. I'm going to read a little bit here. Right, so it says, as I mentioned, I was a financial advisor. I got licensed in 2012. I did not hear the term accredited investor until 2015. In 2015, I still didn't know what it meant or what its significance was. When I asked the advisory firm I brokered with what it meant, I got a very blunt communication from their compliance department saying an accredited investor was either an individual or family that had a net worth of over $1 million, or a trust or corporation with assets over $5 million. They wanted to tell me that I was not allowed to talk about accredited investors and that we did not provide any services for accredited investors, and that was that. I asked a question and I got a gag order given as a response. Now, I was an independent financial advisor. That meant that I wasn't captive to any agency, company, product, or service. If it existed, I could sell it. So needless to say, my confusion was pretty great when I was told that I could not offer any services to accredited investors. It made me wonder why. So me being me, I did some research, and by some, I mean a lot, and I went digging. Right, so this is actually what I'm writing about in the book here. This is what happened. Here's what I found out. An accredited investor can mean, number one, a married couple that makes $300,000 per year, or a single person that makes $200,000 per year for 2 years in a row. Right? So you're either married and you make $300,000 a year at least 2 years in a row. Right? Taxable income. Not before your deductions and all the stuff you do to lower your bill. It's taxable. Right? Or you're single, you make $200,000 a year for 2 years in a row, also taxable income. Okay, so that's an accredited investor. That's one of the main definitions. There are 5 of them. I'm only going to cover 2 tonight, right? The second definition, an individual or a married couple with $1 million net worth, excluding the value of their primary residence and the debt of their primary residential mortgage. So what does that mean? All of the things you own, not including the value of your house, minus all of the things you owe, all of the debt that you have, not including the balance of your primary mortgage on your residence, on your house, right? The difference there, the surplus, if you've got $1 million surplus, you're considered an accredited investor, right? Now, why is that so important? Okay, why is that so important? Now, the accredited investor has access to investments that most Americans don't have. Right, now I'm going to talk to you about this in a second. Now, there's two different sides to this coin, right? The first side is the accredited investor thing. This was invented back in the 1930s. Back in the 1930s, and the reason this was created is that the Securities Exchange Act was created. The SEC, Securities Exchange Commission, they regulate all the investments and stuff in the financial world. If you think about back in the 1930s, what had just happened? Right, we just had the 1929 stock market crash. We had the Great Depression starting, right? It was a very interesting time in our nation. We just had the 1920. So what actually caused all of that? It was manipulation of the market. There were investments and stocks and bonds and things of that nature being sold. There was no regulation, right? It was the Wild West. Okay, a little bit like cryptocurrency is today. There's not a lot of regulation on it. People can just come up with one and that's that, right? So this was the case with stocks and bonds, like securities is what these are called. So because basically it was one giant pump and dump, right? Wall Street pumped up and hyped everyone up and they sold all the stocks and bonds and then they dumped it and they pulled all their profits and Americans lost money just like always happens. And so the government came out and said, hey, we have to protect the everyday consumer. Companies need to do certain registrations and filings and they need to submit all their paperwork in order to offer investments to the general public, right? Well, certain investors didn't want to. They said, hey, we're not interested in that. That's expensive. We're not playing that game anymore. It doesn't work for us. So they came up with what's called an unregistered security. An unregistered security means they don't do the paperwork with the SEC and FINRA and all of this stuff to be legal. Okay, FINRA is another compliance regulator in the investment industry. They said, hey, we're not going to do that. We're going to be what's called exempt. We don't need to file our paperwork. We don't need to be, all of the stuff that these publicly traded companies are doing. We don't need to be doing any of that, right? And the reason why is we're going to be excluded. We're only going to be for an accredited investor. Our investments are reserved for those people only, right? So because of that, there's a whole world of accredited investments that are terrible, okay? 70% of them do not make money. They lose 70% of the time. Why? Because everyone and their cousin can start one. If you pay $10,000 to a lawyer and you can write good ad copy and act like you're something, you can basically be an influencer or a guru, you can start a private fund and offer for accredited investors only, and you can have zero experience. Okay, if you're watching, show of hands, in your car, in your living room, wherever you are, if you would feel comfortable investing in a fund with someone that had zero track record, zero actual experience, zero real wealth. They just paid $10,000 or $20,000 to an attorney who set them up with a private fund, and now they can raise your money in their retirement funds and all this different stuff that they're doing to invest in their fund, and 70% of the time you're going to lose money. Okay, I'm not interested in that. You can put your hands down if you had your hand up this whole time, right? I'm not interested in that. But 30% of the time it works. Okay, and the 30% of the time it works, it's because it's with established companies that have a track record, that are investing in things that are true, like they're actually real assets. They really do what they're supposed to do. They've been around for a long time, and in the foreseeable future, they're not going anywhere. Right? And they do provide information. Like an accredited fund technically doesn't have to provide, let's say, financial statements. There's exemptions for that. Well, a good fund is going to do that anyways, right? If they're going to show the IRS, why wouldn't they show their investors, right? These are the kind of things I'm talking about. But 30% of the time you get good investment opportunities that do that. Now, why does that matter? Because as an accredited investor, when you invest in the right ones, that 30% of the time when it's a good fund, a good business, a good manager, a good asset, right, you're going to make more money typically than in a non-accredited fund. Now, that's not a guarantee. I'm not offering you an accredited investment right now, so don't be like, Jerry said on a video, and now I signed up and I did one of the ones that lost money, and now it's his fault. I don't want that either, right? But I'm telling you that if you do it correctly, I have done these in ways where I make good money, right? I'm going to give you some examples of this, okay? So again, and this is guys, this is all in the book. So if you're watching this, we're covering just a tiny little bit. This is all in the book. So if you want the full picture, you can get the full book, right? Hey, you want to see a magic trick? Get a copy of my book, Blueprint to Financial Freedom. I know it's in front of my chest and my face because I want you focusing on the book and not me for a moment before you go back to focusing on me and the content. But I'm going to give you a little bit here on the whiteboard. So I want to give you some examples of accredited investments, right? So first things first, first one I want to share with you is called life settlement investing. This is one of my favorite ways to invest as an accredited investor, right? So a life, it looks like life settlement. So basically you have a person who has a life insurance policy and they're typically older. They're going to be like 70 to maybe 90 years old. That's their age, right? And so they have a life insurance policy that they've been paying into. It has a cash value. They're covering their premiums, and they would rather just have money, right? So if they were to sell this life insurance policy back to the insurance company, it's called surrendering. They were to give it back and cancel it. The insurance company would give them what's called their net surrender value. Okay, their net surrender value. So that means if they had $50,000 in their cash value and they canceled their policy, the insurance company is going to give them exactly $50,000, right? Now, what they can do, because a life insurance contract is personal property, this goes back to a law that was established in the early 1900s, they can sell that life insurance policy to an investor, right? The investor has money. This guy has an insurance policy. So they're going to be able to sell this insurance policy to the investor. The investor is going to give them money, and typically they're going to get multiple times more than the insurance company would give them, right? So the insurance company was going to give them maybe 50,000. The investor might give them 100 or 150 or 200,000. The highest I've ever seen quoted was 23 times the cash value, right? That's kind of unusual, but usually, 2, 3, 4, 5 times more than they would get from the insurance company. So this person is really happy. Why? Because they're able to get out of this life insurance policy. This life insurance policy has premiums attached to it, and they're older. They can't afford those premiums anymore. They're in retirement. It's not something they want to keep paying, but they don't want to just cancel and basically get only what the insurance company has. Okay, so they're going to sell it to the investor. They're going to get maybe 3 to 5 times what they had in cash value. They're going to make money. The investor, he now takes over the policy. He also takes over the premium contributions, right? Now, the other thing that happens is this guy that sold it remains the insured. He is still the insured on the policy. The investor now becomes the owner and the beneficiary of the policy, right? So when this guy passes away, when he sells this, he does a life expectancy study with a doctor. They do a full report and they say, hey, this guy has, between 2 or 5 or 10 years to live, whatever it might be. Very above board. He's aware of it as the seller. The buyer's aware of it. The doctor's in the middle providing all of this data, right? When he passes away, the owner gets the death benefit. The investor's now the owner. He gave the money. He's going to get the death benefit, right? The beauty of investing this way is the death benefit's your return. That's the money you're going to get. You know exactly how much money you're going to get. It's not correlated with any asset class. It's not based on the stock market. It's not based on interest rates. It's not based on the economy. It's based on 2 things, 3 technically. Okay, number 1, if you're doing this through a fund, is that fund one of the 30% of private funds that's going to make money, right? Are they doing a good job? Are they above board? Do they have good management? Number 2, the insurance company, the solvency of the insurance company. Now, most insurance companies have lots of reserves. They're also required to have insurance at a state level as well. So that's a pretty okay gamble too. The third thing is the lifespan of the seller, the insured that sold the policy. Do they live as long as the doctor report thought that they would? Okay, so here's an example of this. I might put in $100,000 as an investor. That might buy me interest in 6 policies. right? Over the next 5 to 10 years, these 6 policies are going to pay out, right? Pay out, pay out, pay out as these insureds pass away, right? They're happy because they have money for retirement, medical expenses, whatever it might be. As they pay out, I receive my share of the death benefit. By the end of, let's say, 10 years, I might have $200,000 or maybe $250,000, depending on how I've invested and how the policies are, right? So I'm earning 8 to 12% on an average basis each year, but it's coming through these maturities and I know exactly how much it's going to be. There's no gambling or question about it. That's my share of the future death benefit, and when that pays out, I will get that number. And I also know exactly, like, okay, good, this is how it's going to work. Like, it's not based on how did the market do today? Where are the interest rates at? Who's the president? I don't have any of that stuff with something like this. Okay, so that's one of the things you can do as an accredited investor, right? Another one, I'll give you another example here. This is a more recent one that came across my desk with a precious metals partner of ours. You can do gold and silver bonds. Right? When I say gold bonds, I'm not talking about the foot powder either. I'm talking about you can do a bond that is collateralized with gold and silver, meaning you buy gold and silver as a precious metal, like a physical precious metal, right? So number one, you buy the precious metals. As an accredited investor, you can then invest those metals into a fund. Right now, a bond is a loan, meaning you're basically doing secured collateralized private lending with gold and silver. Right now, this one in particular I'm mentioning, this is investing in a mining operation, right? A very well-known mining operation. They're loaning out on a bond. The mining operation is going to pay the interest on the bond. They use that to basically do the mining and fund all the equipment and all of this stuff, but they pay the interest in gold and silver, right? So this particular one, and this is, again, this is not an offer. I'm not a broker. I'm not any of those things. I'm just telling you what I know here. So if you're interested in these things, you can ask me who I'm working with. I can connect you with them, all of that kind of stuff. Do your own research, do your own due diligence. I'm just sharing with you what I know and what I'm doing, okay? This particular one is paying 12% interest per year to accredited investors only. They've got to be accredited, right? And that 12% per year is being paid in silver, which is pretty cool, right? Why is that pretty cool? Because if I loan out $100,000 in US dollars, right, I'm going to be paid back 12% in what? Dollars. What do dollars do guaranteed? They go down in value, right? If I do $100,000 worth of silver and I loan that out on a bond and I'm being paid 12% interest in silver, I'm being paid back in silver. Right? They have to return back the ounces that I loaned out to them, not the dollars, the ounces. So my loan could actually appreciate if silver goes up and they give me back, let's say I did, I don't know how many $100,000 would be, but let's say 10,000 ounces of silver. I'm probably wrong on that, but let's pretend that's the number, okay? 10,000 ounces of silver. Well, if spot price on silver was $27 an ounce when I start, and I get back the 10,000 ounces of silver at the end, and spot price is, let's say, $30 an ounce, I've made money on my return of capital. I don't get that usually on a bond. I get 100,000 back, and if it's been 3 or 4 or 5 years, that 100,000 is worth less than I started. Plus, the interest I'm getting is being paid in silver as well. Right? So that's another one that's reserved for an accredited investor. Okay, the final one I'm going to share with you. Okay, this is called oil and gas drilling. Again, this is not an offer to invest. I'm not a broker, I'm not an advisor, I'm not an agent, I'm none of those things. So please do not watch a YouTube video and be like, I'm doing that. This Jerry guy said to, and so I'm gonna go find the first one on Google and sign up, and if it doesn't go well, I'm gonna send him a nasty email and leave a bad review, okay? Don't do that. Now, we have registered investment advisors we work with. We have professionals who can help you with this. If you're one of our members, that would be the route to go through, okay? But I want to share some education with you on this. So this is oil and gas drilling. Now, with this one, again, you need to pick one of the funds that does well. Oil and gas drilling is not guaranteed. There are risks involved. You can make money, right? But you need to work with someone that's got a track record, period, end of story. Okay, so same example. Let's say that I invest $100,000. I had a client do one of these late last year, right? So he invested $100,000. He was able to get a tax write-off, or it's a deduction, a tax write-off of $98,000, right, on his 100. So he puts 100 in. He's buying into an oil and gas drilling operation. They're drilling oil and gas out of the ground. They're producing barrels of oil. Those are being sold and whatnot. And he's able to deduct $98,000 of that 100 grand off on his taxes, and the full 100,000 goes to work. Okay, I'm going to repeat what I just said. He put in 100,000 and he can deduct 98,000 of it off on his taxes. Just imagine that. Like the best, closest thing that a non-accredited investor has to this is a 401k, which is not even technically an investment. It's just a tax code. You put in money and you get a deduction. However, that money's locked up till you're 60, right? You don't get passive income and all this other stuff. This guy's money's not locked up. Okay, as the oil produces, it's going to pay him every month. Okay, sometimes I've seen these where they can be in the 12 to 15% per year range as far as the income he's receiving. Now, as the drill does deplete the ground and the oil runs out, that does go down over time, right? At the end of it, he has basically a stream of a little bit of oil left, and that's going to pay him until it runs out. But he recoups all of his capital and he earns interest on top of it. This 12 to 15%, some of this is also tax favored, right? So you've got an investment opportunity for an accredited investor only, where you're putting 100,000 in, you're getting a deduction on like 98% of that, writing it off on your taxes that year. You're getting potentially a very high return on an annual basis from the production of the oil and gas drill, right? And you've got tax favored treatment on that income, right? So that's the beauty of this. Now, here's the thing I want to make sure you know before I stop this today. The thing I want to make sure you know is you don't need to become an accredited investor to become financially independent. I don't actually recommend you even do that. I think you should become financially independent through non-accredited investments. Why? Because those are scalable. And if you do things like real estate, if you do things like the sacred account, if you do things like precious metals, you control those, right? And you have a stable base foundation so that once you become financially independent, which for most people probably will happen between $2 and $3 million invested, that's going to pay you $20,000 to $30,000 a month in passive income if you do it right. Then you would say, okay, good, I'm financially independent. Now I'll invest in accredited investments. Why? Because I can't go backwards now, right? Like I said, these are 70% of these accredited investments, they fail. So if I'm in one that fails, okay, it sucks, but I'm okay. Why? Because I'm financially independent. I don't rely on that money. Now, if I use accredited investments to become financially independent, let's say I'm earning $200,000 a year as a single person and I qualify. I'm earning $300,000 a year as a single or as a married couple and I qualify. Maybe I've got $1 million net worth, but I've still got another 2 or 3 million I need to go on before I'm truly financially independent. And I start getting there through accredited investments, and the bottom falls out on those because they can be risky. You're going to experience what I experienced. I had to go all the way back down to the beginning and restart, and it wasn't fun. And I can tell you that from firsthand experience. Now, I did rebuild. But as I rebuilt, I focused on my businesses, my investments, my gold, my life insurance, the things that I can control. I didn't do any accredited investments to get back up, right? So that's my thought. That's my recommendation. Now, if you're watching this or listening to this and you want to learn more, right? We covered a little bit in the book today, but we didn't cover it all, right? And so I want to give you the opportunity to grab a free copy. If you scan the QR code on the screen, you can grab a free copy of my book, Blueprints Financial Freedom. The other thing you can do is you can go to jerryfetta.com/B2F promo. You can get a free copy of the book at that link as well. But guys, my mission is to help as many people as I can, right? As many people as I can increase their financial understanding of wealth so that they can improve the quality of life of themselves, their loved ones, and the world around them. And that's why I do this education. That's why I'm teaching this to you tonight. Right? So if this made sense, get the book. That's your next step. Get the book, read the book. If it still makes sense, you can jump on a call with someone from our team Shoot, I'll even talk to you myself if you have questions, right? But the fact is, this all starts with education, right? If more people were educated, as I said at the very beginning, the 1930s bubble never would have happened. If more people were educated, the statistic would not be that 70% of accredited investments don't make money, because people wouldn't invest in the ones that don't. They would be educated enough to know and to look and say, that doesn't look like a good one, I'm not doing that, right? So if you're interested in getting educated, that is where it starts. It doesn't start with us talking about the latest, secret smoke behind the curtain deal of accredited investing world and all of this stuff. No. Get the book, read the book, keep tuning in, keep following. We will be back again next week, next Friday. Same time, same place, 8:30 p.m. Central Time for Finance Friday. That's all I got for you this evening. Thank you guys for watching, and I will see you next week. Hey, this is Jerry Fetta here. I want to thank you for watching my video, watching my content. I hope you enjoyed it. If you would like to learn more about the blueprint to financial freedom and how you can achieve passive income that exceeds your savings, your expenses, your taxes, your generosity, and build wealth like the top 1%, I want to encourage you, grab a copy of my book, The Blueprint to Financial Freedom. You can go to jerryfetta.com/B2F promo, or you can click the link in the description of the video here. The copy is free. You cover your shipping. We'll send the book out to you, and we'll send you an email with a bunch of great bonus material also for free. Get the book, subscribe to the channel. I'll see you on my next content.